Hello and welcome back to the complete day trading course by Wealthy Education. In this video, I'm going to talk about dead cat bounces, how to trade them. There's also inverted dead cat bounce. So a dead cat bounce it's the idea is that you're on top of a building, you throw a cat off the top of the building, and it hits the ground and it bounces. And it heads right back down. The history of this, I'm not sure why they chose a cat, but that is the meaning of this. And essentially what that means is that even though it bounces, it doesn't necessarily mean that it's ready to turn around and rally. It's just simply a natural reaction. And then you continue back towards the ground. Gravity eventually takes over. Now, there's also such thing as an inverted dead cat bounce, which is the market rallying, pulling back, and going forward. It's traded the same way. It pretty much is the same thing. Now, a dead cat bounce, typically when people will talk about it, they talk about it on longer term frames, time frames. But in our situation as day traders, we do see them occasionally. And what we want to see is we want to see it happen over the course of a couple of days because you really want momentum to pick up. So let's say you're looking at U.S. steel. On the 15-minute charts, I've got pulled up. You get involved in this day and something happens to really send the market into a frenzy. You can see this massive volume spike. You can see I'm zoomed out here. We have a lot of selling. That first day, the second day continues to sell, third day, etc. So eventually you get another gap down and you start to rally. And the idea is you want to sell the rally. So there's a couple different ways you can do this. You look for an area that perhaps was previous support or resistance. And in this case, let's say that on the longer term chart, $31, $31.50, $32, this whole area here had previously been resistance. We broke above it. We pull back. And on the longer term charts, it does in fact show that. So we break through this area. We come back where we retest it and it's time to sell. So that's one way to look at it. But really what we want to do is we want to stack the odds in our favor as much as we can. So what I like to do is on a gap down from the place that it happens, draw a fib and just simply wait. Now, there comes a point where you have to kind of use the confluence of factors. And in this case, like I said, there were support and resistance. There's an area here between 31 and 32 that attracted a lot of attention in the past. It's also a box between the 38.2 Fibonacci and the 50% Fibonacci retracement level. And you can see it was, in fact, a selling opportunity. So what you're doing is, as it rallies like this, you recognize that that was the recent high, but there's a lot of noise here. There's a lot of reasons to think that this could cause some trouble. Certainly the volume spiked here. So you're looking for a tradable pattern in this area, and you just simply wait until it appears. There's nothing magical about trading these things because what happens is, somebody who is long of this stock and this happens to, they're trying to mitigate the damage. So they get trapped, they get out as quick as they can on a bounce because it gives them the opportunity to perhaps recover some of those massive losses. In stock markets, these do happen occasionally. A lot of times it comes down to earnings, though. So, for example, this market here, this is Disney, and this is a little bit more liquid, so you won't see this as much. But clearly, so you can see that we gapped lower and we turned around and spiked higher. We rallied and we pulled back. So if you've missed this move, and it was nice volume, again, you could look for previous support and resistance. That's one factor to put in. And keep in mind that it's right here at about 150.50 or so. On this move, you could also do a fib. I draw that. So somewhere right in this area is what you're looking for, a supported buying opportunity. And we did, in fact, gap higher on this day, and that was a signal to go long. Now, like with all things technical analysis related, higher time frames certainly mean much more. When I pull up a daily chart, this is a dead cat bounce. You could draw, let's see, it started basically from here, so you could draw this, and, it started from here. You can draw this, and you can see the 61.8% Fibonacci retracement level offered resistance on the daily chart. And it is an area where we've seen traders go back and forth a couple of different times. So with that candle and then the gap lower, that was a clear trading signal. You got in at about 102.5. It got all the way down to 90. So it does work in all time frames. You clearly want it to line up with something else. I like support and resistance and fibs. It makes for a nice meeting of the two forces. You don't always get a re-entry. So that is a bit of a problem. Sometimes it's just a runaway market, and then you just trade it as a gap. But really, there's a little bit of an art. But like all things, you want a couple things to line up. This is probably one of the trickier ways to trade. That was the last video in Module 3. Thank you for entering the course. I hope you learned a lot, and happy trading.